Okay, let's start with a question that probably hits close to home for a lot of people listening. Do you really own your house? Especially, if you're still paying that mortgage.
Hmm.
It feels like ownership, right? You live there, you fix the leaky tap.
To paint the walls.
Exactly. But financially, the picture can be, well, a lot more complex than that.
That's really the crux of it.
So today we're doing a deep dive into this exact question. We're looking at source material that explores the kind of intricate realities of property ownership.
Yeah, and specifically through the lens of different mortgage systems, how they work around the world.
Right, because it's not the same everywhere.
Not at all. And our sources really try to unpack what that long-term debt obligation, which, let's face it, is part of buying a home for most people, actually means in practice.
We're talking years, often decades, of payments.
Decades, yeah. So we'll look at examples. The source mentions places like the UK, the US, Sweden, and Switzerland too, comparing how these different systems actually structure that relationship between, the homeowner and the lender.
And the material we're looking at doesn't just stop at the traditional stuff either, does it?
No, it pushes a bit further. It brings up some really fascinating questions about emerging technologies.
Like AI.
Like AI, yeah. And also decentralized finance, DeFi, crypto, that kind of thing.
And how those might intersect with these sort of established systems.
Yeah.
Or maybe even create totally new financial ecosystems.
Exactly. The potential disruption or maybe evolution.
So the goal here for us and for you listening is to kind of cut through the jargon, the complexity that the sources present.
Right. Highlight the key insights about these different mortgage systems, the strategies people might use within them.
And also touch upon those more future-looking points the source makes about tech.
Yeah, because while they might seem like separate topics, mortgages here, tech over there, the source material kind of links them.
How so?
Well, both challenge us to think about understanding complex games, you could say.
Games.
Yeah, in a sense. Whether it's the game of property finance with bricks and mortar and decades of payments,
Okay.
or the game of new digital platforms with bits and bytes and, really rapid innovation. It's about understanding the rules.
Got it. So think of this as your shortcut, maybe, to understanding some fundamental financial structures that many of us deal with every day.
And getting a glimpse into how that whole landscape might be shifting.
Sounds good.
And just before we properly jump in, a quick note about who makes this deep dive possible.
Right.
This program is brought to you by blockchaincompany.info, which is our media platform.
And it's sponsored by 4IR Utility Token and 4R GPT.
That's right. And we will actually touch upon that 4IR utility ecosystem later on. It's mentioned in our source material as a platform for AI knowledge exchange.
Okay.
So you can learn more if you're interested by visiting 4irtoken.com and also 4irgpt.com.
All right, great. Let's get into the thick of it then.
Let's do it.
The source material really kicks off with a pretty impactful observation about the reality of owning a home for the vast majority of people.
Mm-hmm.
It suggests buying a home isn't so much about just, acquiring it outright.
Like buying a loaf of bread.
Exactly. It's more about entering into a very long-term, sometimes lifelong financial commitment, basically a debt obligation.
That's the core framing, yeah. The material points out that across major regions, it lists the EU, UK, Canada, the US, an overwhelming percentage of homes.
How overwhelming.
Well, it puts the number at roughly 98%.
98%.
98% of homes in those areas are acquired using mortgages.
Wow. So it's not just like a common way to buy a house. It's basically the only way for almost everyone.
It's the dominant pathway, yeah. And that traditional image of saving up for years and years, buying a house with cash,
It's a dream, right?
it's the exception. It's really not the rule for most people today.
And the source argues that this simple fact, needing a mortgage, fundamentally changes what ownership even means, especially at the beginning and often for, most of the time you live there.
It really does. The material suggests that because a lender finances the purchase, the bank effectively holds a huge stake. Arguably the primary claim or stake in the property for, the entire duration of that loan.
The primary claim.
Yeah. And it uses pretty strong language here. It suggests that buyers almost never, ever own the property free and clear, not in the way we might think.
Almost never, ever own the property. That's a provocative statement, isn't it?
It is. It implies this perpetual state of financial obligation to the lender rather than achieving that outright, unencumbered ownership.
We sort of grow up with this idea, don't we? Homeownership means building equity, paying down the loan until one day, poof, the house is actually yours.
Mm-hmm.
But the source seems to be arguing that for most people, the reality is more like a continuous financial entanglement with the bank.
That's a good way to put it. Entanglement.
Your ownership is basically contingent on keeping up with those payments. It's the right to live there and, well, pay for it.
Exactly. The mortgage isn't just framed as some temporary bridge you cross to get to ownership island.
Right.
In this framing, the mortgage defines the relationship for the vast majority of the time the buyer is connected to that property. It becomes about managing the debt, maybe leveraging it, rather than just getting rid of it to achieve pure, simple ownership.
Okay, so if that's the baseline, this ongoing obligation, how do different places structure this whole relationship? You mentioned the source looks at different countries.
Yeah, and that's where it gets really interesting, seeing the variety. It provides a comparative look, which is super insightful because, honestly, there isn't just one way this is done globally.
So let's start with the systems maybe most familiar to listeners, perhaps in the UK or the US.
Okay. The source describes these contexts, and it mentions two general types of mortgages you often find there: interest payment mortgages and repayment mortgages. And it notes the situation is, broadly speaking, quite similar in both the UK and the US.
Okay, interest payment and repayment. Let's take the interest payment one first. The source highlights this often being like the more accessible option at the start.
Yeah, that makes sense, right? Especially for, say, younger buyers, maybe people in their mid-20s just getting onto the property ladder.
Or maybe starting a family, budgets are tighter.
Exactly. Those lower initial payments can seem really attractive, maybe even be the deciding factor that lets them buy at all.
Good. What's the catch? Or the key feature?
Well, a key characteristic, as the source points out, is that the interest rate on these interest-only loans is often variable.
Huh.
It's frequently tied to some kind of fluctuating benchmark rate. The source mentions the Bank of England base rate as an example.
Right, so that means your monthly payments aren't fixed. They can go up or down, I guess.
Potentially, significantly up or down, yeah, depending on what's happening in the wider economy, central bank policies, that kind of thing.
Which obviously introduces a level of uncertainty.
Yeah.
Makes budgeting tricky. We've definitely seen that play out recently in different places.
Absolutely. It can be a real challenge for household finances. But the most critical point the source makes about these interest-only payments, it goes right back to that core idea of ownership.
Okay.
When you're only paying the interest, you are, and this is a quote from the source, just paying interest on interest loans basically forever, it seems.
Just paying interest on interest loans basically forever, it seems.
Yeah.
That phrase really hits home, doesn't it? It captures the source's point perfectly. Your monthly payment is just covering the cost of borrowing the money.
The rent on the money, essentially.
Yeah, the rent, but the actual amount you borrowed, the principal, that stays exactly the same, untouched.
Correct. You're paying for the privilege of having that loan month after month, maybe for decades, without actually reducing the total amount you owe the bank.
It feels very much like a perpetual rental agreement, but for the money itself, not the house.
It fundamentally separates the cost of having the debt from the act of reducing the debt.
So how do you actually start owning more of the house then? Paying down that principal?
Well, according to the source, to actually begin that process, reducing the principal balance you have to transition, you need to move to a repayment mortgage structure.
Okay, and what's different there?
That's where a portion of each monthly payment you make is specifically allocated to chip away at the original loan amount.
Right, so part goes to interest and part goes to the principal.
Exactly. You're paying both. That's how you start building equity through repayment.
And the source also mentions things like remortgaging, leveraging equity, home equity loans. How do they fit in?
Well, it frames these less as ways out of the system and more as further interactions within this whole complex structure of ongoing debt.
So not necessarily escaping the debt, but maybe rearranging it.
Precisely. Remortgaging often means restructuring the same debt. Maybe you get a better interest rate or different terms, but you might also extend the overall payment period.
Or even borrow more money against the house's value.
Right. Leveraging equity or taking out home equity loans is basically taking on more debt, using the property as collateral, which, further embeds the owner within that financial system tied to the home.
It's like a constant dance with the lender.
It really is. It paints this picture where, for a huge number of people in these major economies, the sort of default setting for home finance seems geared towards managing a potentially lifelong relationship of servicing interest payments.
rather than having a clear, aggressive path towards owning the place outright.
Exactly. And understanding that default state and the fact that you often need to actively choose or transition to a repayment structure if full ownership is your main goal, that's a really key insight from the source material.
Okay, that's a sobering look at the UKO's context, but the source provides contrasts, right? Let's turn to the Swedish mortgage system. The example mentioned is buying an apartment.
Yes, the Swedish system, as described in the material, it sets things up differently right from the start. It introduces a defined mortgage term.
Defined term.
Yeah. The source uses an example of a 50-year term for an apartment mortgage.
50 years. Okay, that's still a very long time, no doubt.
Definitely. But the key difference seems to be the definition of that term and, crucially, what happens within that term.
Ah, okay. So what does happen?
Well, the Swedish system, as described, includes a specified annual amortization rate right alongside the interest payment.
Amortization, so paying down the principal.
Yes. The source cites an example of a 2% annual amortization rate being included in the required payment.
So from day one, your payment is automatically structured to cover the interest and actively reduce the principal balance by a set amount each year.
That's the fundamental difference compared to that initial interest-only scenario we just talked about. In the Swedish example, the payments are designed from the get-go with a clear trajectory towards reducing the debt.
No need to switch or opt in later. It's built in.
It's built in.
And the outcome described seems pretty straightforward then.
It is. Consistent payments over that defined term, say, the 50 years in the example, lead directly to the full amortization of the loan.
Meaning you actually achieve outright ownership of the property at the end.
You reach zero debt on that property. It's paid off.
That sounds much closer to the traditional idea of paying off a mortgage.
It does. And the source even includes a little anecdote related to this.
Oh, yeah?
It mentions that if the property happens to be rented out, the rental income you might get, based on market prices, could potentially cover the entire monthly mortgage cost.
The entire cost, including both the interest and that 2% principal repayment.
That's the scenario presented. So imagine that. After 50 years, you could end up with a property you fully own, where the cost of servicing the debt over that whole period was potentially covered by rental income. Effectively, the source suggests making the property free relative to your initial investment.
Which might have been, what, a 15% down payment, the source mentioned?
Something like that, yeah. So it highlights a system that seems structurally designed for the debt on the property to eventually be extinguished within a set time frame.
Offering a very different perspective on that relationship with the lender compared to the idea of perpetual interest payments. It's a clear path, a defined end goal for the debt itself.
Exactly. A very different model.
Okay, so Sweden offers one clear path to ownership. But the source introduces another system, one described as quite significant for the wealth of Swiss banks.
Ah, yes.
The Swiss infinite mortgage system. That name alone sounds unique. And maybe a bit ominous.
It certainly sounds unique, and the source provides a pretty detailed breakdown. It uses the example of buying a property valued at 1 million Swiss francs, presumably.
Okay, a 1 million property.
Yeah.
Let's follow the money based on the source's description.
All right, first step, the down payment. The source states this is typically 20% of the property value.
So 200,000 in this example. That seems fairly standard, similar to other places.
Right. So far, so familiar. The amount left to finance is 800,000. Now, here's where the Swiss system, as the source explains it, takes a sharp turn. This 800,000 mortgage amount gets split into two completely distinct parts.
Split. Okay.
Yeah.
2 loans almost.
Sort of, yeah. Two parts with different rules. Part one is the smaller portion. The source calculates it as representing 13.3% of the total property value, so 133,000 in our 1M example.
Right.
This specific smaller chunk must be amortized. It has to be paid down over a defined period. The source gives an example like 15 years at whatever the agreed interest rate is.
So your monthly payments do include paying off the principal plus the interest, but only for this smaller part one.
Exactly. For about 13% of the house's value, it behaves like a standard repayment loan, paid off over, say, 15 years. Seems straightforward enough.
Okay, got that.
But then there's part two. And this is the much, much larger remaining portion of the mortgage.
How much larger?
In the 1M example, after the 200K down payment and the 133K in part one, you're left with 667,000. This represents 66.7%, 2/3 of the total property value.
Okay, the bulk of the loan.
The vast bulk. And here's the absolute kicker, the crucial difference highlighted by the source. This larger part two, does not have to be amortized.
Ever.
Ever.
Wait, so for 2/3 of the value of the house that you've borrowed money for, you are never actually required to pay back the principal amount?
That is precisely what the source explains. For that huge 667,000 chunk, part 2, you are only ever required to keep paying the interest rate to the bank.
Just the interest.
Just the interest, indefinitely. This is the core mechanism behind what the source calls the infinite mortgage.
Wow. An infinite mortgage. So let me get this straight. For the first, say, 15 years, your payment covers amortizing that small part 1 plus the interest on the whole $800,000.
Correct.
But then after part 1 is paid off around year 15, your monthly payment drops.
Yeah.
But it doesn't go away. You're still left paying just the interest on that massive $667,000 part 2.
That's the model presented, yes.
Year after year after year.
Yeah.
Potentially forever.
That's the implication. The source details the long-term consequences, stating these interest payments on that large, non-amortizing chunk could continue throughout your entire lifetime.
A lifetime.
And quite chillingly, according to the source, that obligation could potentially even be passed on to your heirs, your children.
Passed on to the next generation. The debt.
That's what the source suggests is possible within this system.
That is. That's a radical departure from the whole concept of paying off a debt to own something free and clear within your own lifetime. It completely reframes the financial legacy you might associate with property.
It certainly does. And the key takeaway from the source about this specific system is that, unlike the Swedish model we just discussed, you typically don't get to own the property at some future moment by simply paying off the debt, because a huge chunk of the debt is never scheduled to be paid off.
Yeah. The bank effectively retains a permanent financial claim on that large portion of the property's value.
That seems to be the structure, yes.
So if you never actually pay off that big chunk, what does your ownership even represent in that system? What are you building?
That's a great question. The source clarifies that your ownership stake, your equity in this context, is primarily the delta between the future price and your debt to the bank when you decide to sell it.
A delta, meaning the difference.
Exactly. Your financial gain comes mainly from the property's value going up over time, minus that perpetual debt amount you still owe on part 2, plus anything left on part 1 if you sell early.
So equity in the traditional sense, the part you own because you've paid down debt, is only really built on that small amortized part 1.
And any appreciation in the property's market value itself.
That's a massive distinction. Your wealth isn't primarily built by reducing your debt load, but by hoping the market value grows faster than the huge fixed debt amount you're carrying.
It puts a very different kind of emphasis or pressure, maybe, on property appreciation, doesn't it?
It really does. And does the source mention any downsides or challenges with this beyond the, infinite debt part?
It does note potential difficulties, particularly later in life. For instance, if someone maybe hasn't developed great financial habits, or perhaps relies heavily on their pension funds to cover those ongoing, potentially quite significant interest payments.
Well, I can see that.
It could create real problems, especially after retirement when income might drop or become less predictable. Managing that perpetual interest payment could become a burden.
It just hammers home again how absolutely crucial it is to understand the specific rules of the financial game you're playing, wherever you happen to live.
Absolutely. Because the implications for your long-term financial health and even your basic concept of what ownership means are just profoundly different depending on the system.
These comparisons, UK interest-only tendency, Sweden's defined payoff, Switzerland's infinite interest component, they show there's no single global approach.
Not at all. And the nuances in how these mortgages are structured have massive consequences for the individual homeowner.
It really makes you rethink the whole thing. Buying a home isn't just finding a place you like. It's stepping into a specific, often very complex financial architecture.
An architecture that varies significantly by location.
And understanding that architecture, as the source suggests, is the essential first step to navigating it effectively, or maybe even strategically.
Which actually brings us to a really interesting point the source makes about the Swiss system.
Oh, yeah?
Yeah, it describes a potential strategy, or a twist, as the source calls it, that someone who is, let's say, financially savvy might employ.
A twist. To kind of counter or maybe optimize within that infinite payment structure.
Exactly. The source shifts from just describing the system to discussing a potential proactive approach someone might take. It frames it as something people who are good with their finances might consider.
Okay, I'm intrigued. Walk us through this strategic approach as the source presents it.
Right. It's basically a multi-step process, and it focuses on leveraging the flexibility offered by that non-amortizing part two of the mortgage, the big chunk.
Okay, step one.
Step one involves imagining a voluntary amortization rate for that large bust. Part two, the 66.7% portion you're not required to pay down.
Imagining.
Yeah. The source suggests, just hypothetically, deciding to set aside funds as if you were paying it down at, say, a 1% annual amortization rate.
Okay, so even though the bank doesn't demand it, you mentally commit to acting like you are paying off that big chunk, just at a slow 1% rate per year.
Precisely. That's the mindset shift. Step two, you calculate exactly how much that theoretical monthly amortization payment would be based on that imagined 1% annual rate applied to the principal of part two, the $667,000 in our running example.
Right. You figure out the exact dollar or franc amount that extra payment would represent if you were actually making it to the bank.
Correct. Now, step three. This is the crucial strategic pivot.
Okay.
Instead of paying this calculated amount to the bank, because remember, you don't have to amortize that part, you automatically invest that precise amount.
Invested where?
The source specifically suggests directing this regular investment into the stock market.
Ah, I see. So you take the money that you could have hypothetically used to slowly reduce the principal on part two.
If the bank had required it.
And instead you put that same amount consistently into a separate investment vehicle, hoping, presumably, that it grows faster over time than the interest rate you're paying on the mortgage itself.
That's the absolute core idea of the strategy presented. You're essentially substituting mandatory debt reduction on that large portion with voluntary asset accumulation happening completely outside the mortgage structure.
Clever. Does the source illustrate what might happen if you do this?
It does. It presents a potential outcome based on this approach to show the possible power of compounding returns over time.
Okay, what's the potential result then, according to the source's illustration?
Well, the source runs a calculation. It assumes an average annual return on these stock market investments, and it uses an illustrative figure of 8% per year, which is, a long-term average assumption.
Sure, understood.
And it calculates that these consistent investments, funded by that imagined 1% amortization amount, could potentially accumulate enough capital over a certain period to pay off the entire outstanding mortgage balance.
The entire balance. You mean including both the initial part one that was being amortized and the huge part two that you weren't required to pay down?
Yes, that's exactly what the source's hypothetical calculation suggests. Following this strategy, 1% theoretical amortization rate, invested consistently, earning an average 8% return, the accumulated funds could be sufficient to completely clear the full mortgage balance in approximately 28 years.
28 years. Hold on. That's significantly faster than the 50-year term that was built into the Swedish system example.
It is.
And the Swedish system was explicitly designed for full debt extinction and outright ownership.
Exactly. The comparison drawn by the source is quite stark. It highlights how, within the specific Swiss structure, by leveraging the flexibility of the infinite mortgage part,
The part you don't have to pay down.
and redirecting those potential principal payments into potentially higher growth investments, you could theoretically achieve the end goal of full ownership sooner than in a system built around a fixed, albeit longer, mandatory amortization schedule.
And you'd be doing it using a lower theoretical rate of setting funds aside to the 1% imagined rate here versus the 2% required rate in the Swedish example.
That's the comparison the source makes, yeah.
That really is a twist. It potentially turns what looks like a trap, the infinite mortgage, into a possible opportunity, but only if you have the financial discipline, the investment knowledge, and maybe tolerate the risk involved.
It requires discipline, yes. You're essentially using the bank's willingness to let you not pay down principal on that big chunk as a form of leverage, allowing you to potentially grow capital faster elsewhere.
It's a completely different way of playing the game, isn't it? Focusing on growing assets to eventually overwhelm the debt rather than just chipping away at a debt directly.
It is. But the source also mentions an alternative way you could use the results of this strategy.
Oh.
So not necessarily paying off the house after 28 years.
Potentially not. The alternative outcome mentioned is, instead of using those accumulated investment gains to wipe out the mortgage balance,
Yeah.
you could choose to just keep paying only the interest on the infinite part two indefinitely,
Right, as the system allows.
as the system allows. And in that scenario, you could then use the substantial gains generated from your long-term investment strategy for other purposes entirely,
Like what?
like making further investments to grow your portfolio even larger, maybe diversifying, or perhaps using the capital to acquire additional properties, build a portfolio.
Ah, okay. So you use the investment returns generated by this strategy not to become debt-free on the first property, but maybe to fuel further wealth creation or expand your property holdings.
It becomes about maximizing your overall capital growth within the structure the system provides, rather than prioritizing the elimination of debt on that initial property.
Yeah.
Two different potential end games from the same strategy. Both of those outcomes really underscore the broader conclusion the source seems to draw from looking at all these different systems and potential strategies.
Which is?
It frames the whole concept of property ownership, finance, money itself, as a game.
Money is a game. Yeah, that phrase definitely captures the strategic thinking that seems necessary. It suggests it's not just about passively earning, spending, or saving. It implies rules, mechanics, active participation, strategy.
Exactly. And the crucial advice that flows from that, according to the source, is that to succeed, or maybe even just to navigate this game effectively without getting hurt, it's absolutely vital that you learn the specific rules of the game wherever you are.
Because the rules are different everywhere.
Totally. The rules in that UK context, with its interest-only tendency, are different from Sweden's mandatory amortization path, which are different again from Switzerland's complex split mortgage with its infinite possibility and strategic potential.
You have to know the playbook for your local field.
Right. And once you understand those local rules, the source says you need to have clear financial goals for yourself, and then make deliberate, calculated moves that would get you there.
It's about having a conscious plan tailored specifically to the system you find yourself operating within, not just drifting along.
And the source issues a pretty clear warning alongside that advice.
It does. It says that without truly understanding the rules of the system you're in, and without having that conscious strategy aligned with your own goals, it's very easy to fall into what it calls the trap of the system.
And the trap could be different things depending on the system, right? Like maybe getting stuck paying perpetual interest without building real equity in one system.
Or perhaps not recognizing and leveraging the system's quirks, like that investment strategy potential in the Swiss example, to your advantage in another. It's the risk of being a passive player when the game requires active moves.
But the source adds an important nuance here too, doesn't it? About judging these systems.
It does, thankfully. It adds the perspective that no system is perfect. They all have advantages and disadvantages.
So it's not about saying, Sweden is best or Switzerland is flawed.
Not at all. It's about recognizing that each system has its own unique structure, its own set of rules, and therefore its own potential pitfalls and its own unique opportunities. The responsibility, the source seems to imply, lies with the individual to understand the specific system they are in and then act accordingly based on their goals.
Wow. This whole exploration of different mortgage systems really drives home just how sophisticated and how varied global finance actually is. It's so much more nuanced than just, borrow money, buy a house. It's about stepping into these really complex, long-term financial relationships.
Relationships that are structured very differently depending on where you live.
And which clearly demand a certain level of understanding and maybe even strategic thinking, just to navigate them successfully, let alone optimize them.
It's a powerful reminder, isn't it, that concepts we often think of as straightforward, like owning a home, are actually deeply embedded within these intricate financial architectures.
Architectures that profoundly shape the reality of what that ownership actually means.
Yeah.
Okay, so we've spent a good amount of time delving into the established world of mortgages, the rules, the strategies. The source material then kind of pivots, doesn't it? It starts posing questions about the future.
That's right. It shifts focus slightly, looking ahead and raising some points about how emerging technologies might intersect with, or maybe even disrupt, these traditional financial landscapes.
Okay, what's the first area it flags?
The first question it poses is this. What do you think could be the impact of crypto ownership and DeFi to help finance mortgages?
Crypto and DeFi. Decentralized finance. So, how might technologies like blockchain and digital currencies change how we finance homes?
Exactly. It's presented as a totally open-ended question from the source. It's prompting reflection, really. Could decentralized finance, built on blockchain, and the fact that more people own cryptocurrencies, Could that influence or fundamentally alter mortgage financing as we know it?
What might that look like? Is the source suggesting specifics?
It doesn't provide answers, more like sparks ideas. Could we eventually see mortgages being issued through, say, decentralized protocols, peer-to-peer lending pools using stablecoins, perhaps?
Or maybe even using things like NFTs representing fractional ownership of property as collateral?
That kind of thinking, yeah. The source just flags this as a significant area where future innovation or perhaps disruption could realistically occur, challenging the traditional role.
Right. The traditional roles of banks and these big centralized institutions in mortgage finance could be supplemented or maybe even challenged by decentralized alternatives.
It raises a possibility. Could DeFi offer new ways to pull capital together for lending? Could it create more transparent, maybe more efficient processes?
Or potentially offer different terms, maybe different risk profiles, compared to the traditional mortgages we've been discussing.
All possibilities. It's really about reimagining the fundamental infrastructure, the rails upon which mortgage finance currently runs. Could they be rebuilt using decentralized tech?
Okay, fascinating question. What's the second tech area the source brings up?
The second question takes a look at the role of artificial intelligence, AI, it asks. Also, what will be the impact of AI agents on the mortgage industry or from a consumer to mortgage?
AI agents. So intelligent software acting on behalf of the industry or the consumer.
Precisely. This is presented as a separate but obviously related question. It focuses specifically on AI's potential influence, and the source encourages thinking about it from multiple angles.
Okay, like from the industry's perspective first.
Yeah. Could AI agents, for instance, streamline the whole mortgage application process, perform much more sophisticated, data-driven risk assessments on borrowers?
Yeah, detect fraud more effectively. Maybe automate huge parts of the loan servicing and management process.
Exactly. How might AI change the way lenders actually operate, the decisions they make, the efficiency of the whole system? That's the industry side.
And then from the consumer's perspective,
Yeah.
how might AI help the individual borrower?
Well, could AI agents act as highly personalized financial advisors, helping individuals navigate the incredibly complex mortgage market we've just discussed?
Comparing different systems, different loan offers, maybe even finding niche products.
Or perhaps optimizing their payment strategies? Or even, thinking back to the Swiss example, could an AI agent help execute complex strategies like that investment approach automatically?
Wow. Okay, so the source highlights AI as this powerful technology with the potential to significantly impact both the operational guts of the mortgage industry and the individual's ability to interact with it, maybe more effectively or strategically.
Yes. And again, just like with the crypto DeFi question, the source poses these as points for consideration. It's emphasizing the potential for these significant technological shifts to influence even deeply established, seemingly slow-moving systems like mortgage finance.
It connects back again to that broader theme, doesn't it? Navigating complex environments, whether those are established financial structures built over decades or new technological ones emerging rapidly.
Absolutely. The need to understand the system remains, even if the system itself is changing.
Now, speaking of new technological ecosystems and how they might relate to understanding and leveraging information, the source material also touches on another specific area.
It does. It briefly introduces something it refers to as the 4IR utility ecosystem.
4IR, like Fourth Industrial Revolution.
Presumably, yes. The source describes this ecosystem as comprising two main things, the 4IR utility token and something called 4IR GPT.
Okay, and it presents this as an example of a new kind of digital environment. Focused on what?
Focused on knowledge and information exchange, according to the source.
And the source highlights 4i GPT specifically.
Yes, it describes 4IR GPT as its first flagship platform for AI knowledge exchange and trading. So it's positioning it as a novel kind of platform that uses AI specifically to manage and, interestingly, assign value to information.
Value knowledge itself. How?
Well, the stated purpose of 4IR GPT, according to the source material, is to provide a platform where users can actively monetize their own knowledge, their insights, their professional domain expertise.
Monetize knowledge, so people can get paid for what they know.
That's the idea presented. It frames knowledge itself as a potentially valuable asset that can be exchanged directly on this platform.
How does that work mechanically? How do you monetize insights?
The mechanism described is interesting. It says monetization happens through prompts of intelligence and your domain expertise.
Prompts of intelligence.
Yeah. The source elaborates slightly, referring to it as prompt media engineering. The underlying idea seems to be that users can package and structure their expertise using prompts and then monetize that packaged knowledge on just about anything.
Huh. Prompt media engineering. That's a new term.
Yeah.
And how does a user interact with this?
The user experience is described in terms of creating a presence. The source mentions that users can start their prompt media channel on this 4IR GPT platform,
Like a channel for their specific expertise.
presumably. It also includes a specific detail that new users apparently get 10 free credits when they sign up,
Okay.
which the source suggests can help users get better skilled in this prompt media engineering concept, learn how to package their knowledge effectively using prompts.
And does the source outline potential benefits for people who might use this platform, besides the monetization itself?
It does list a few potential benefits. Firstly, as mentioned, it could serve as another revenue source, offering a way for individuals to earn directly from their specialized knowledge, perhaps outside of traditional jobs or typical freelancing.
Okay, a new income stream potentially. Anything else?
It also posits that using this platform could potentially boost existing income streams someone might have.
How so?
The source gives an example. It suggests someone with, say, a YouTube channel could potentially boost their YouTube income by offering deeper insights or perhaps premium content through a connected 4RR GPT channel, which they might announce or link to in their YouTube videos, potentially attracting paying subscribers over on the 4R GPT platform.
I see. So using it as a way to offer more value, maybe behind a paywall, linked to their existing content?
That seems to be the idea. And related to that, the source also claims the platform amplifies their YouTube channel on 4RUTP2.
Amplifies, meaning it helps them get more visibility.
That's the implication. It suggests that being present and active on the 4IRGPT platform could lead to increased visibility for their primary content, like their YouTube channel, perhaps resulting in more potential subscribers discovering them through the 4IRGPT platform itself.
Interesting. So it's presented as having potential mechanisms for cross-promotion and audience growth built in.
That's how the source material frames the potential benefits and capabilities of this particular platform.
So the source material presents this 4IR ecosystem and 4IR GPT specifically as an example of how technology, particularly AI, might be creating entirely new systems for managing, exchanging, and even valuing assets. But in this case, the asset is knowledge itself.
Yes, knowledge facilitated by AI and structured through prompts. It points towards a possible future where intellectual capital becomes more directly tradable, more easily monetized through these kinds of structured digital environments.
It's fascinating to see how the source connects these different threads, isn't it? We started with the deep complexities of traditional financial systems like mortgages.
And ended up looking at the potential complexities and maybe opportunities in brand new digital ecosystems designed for knowledge.
And in both cases, whether it's old finance or new tech, the underlying theme seems to be about understanding how value is defined, how it's exchanged, and how it can potentially be leveraged.
Within a specific set of rules or mechanisms, whether those rules are set by centuries of banking practice or by lines of code in a new platform.
And both really underscore that increasing importance of being able to navigate intricate systems. It seems like a key skill for the future.
Whether those systems are built on paper and tradition or on silicon and algorithms. Understanding the game, as the source put it.
Right. Well, as we start to bring this deep dive to a close now, maybe let's quickly recap some of the main insights we've pulled from the source material today.
Okay. Well, we definitely saw how the everyday reality of property ownership is often far more complex than just, owning your house, especially when a mortgage is involved.
That 98% figure really sticks.
It does. The vast majority of people enter these very long-term debt obligations, and crucially, they're structured in profoundly different ways depending on where you are in the world.
Yeah, from systems that might lean towards perpetual interest payments if you're not careful,
to others with mandated amortization designed for eventual ownership, like the Swedish example.
And then those really complex hybrid structures, like the Swiss infinite mortgage possibility.
And flowing from that, we learned how critical the source says it is to understand the specific rules of the game in your own location. That knowledge is paramount.
Because it allows you to figure out, is this system geared towards keeping me in debt? Or does it offer a clear path to ownership?
Exactly. And understanding that helps you develop a strategy, whether it's consciously choosing a repayment mortgage or maybe even employing something like that investment approach discussed for the Swiss system.
A strategy to actually meet your own financial goals, rather than just passively falling into whatever the source called the trap of the system.
And then finally, the source material really pushed us to think about the future, didn't it? Considering the impact of technology.
Right. Raising those big open questions about how things like crypto, DeFi, and AI could fundamentally reshape mortgage finance.
And also presenting concrete examples, like that 4i or GPT platform, as potentially new kinds of ecosystems emerging for things like knowledge exchange and monetization.
Suggesting again that navigating complex systems, both the old financial ones and the new digital ones, is likely to be a defining skill going forward.
Absolutely.
It certainly leaves us with a lot to think about, doesn't it?
Mm,
Our relationship with debt, with the idea of ownership, and just how these financial and informational landscapes we live in are constantly evolving.
definitely food for thought. And the source material, appropriately enough, leaves us with one final, quite profound question.
Oh,
A
yes.
question that really cuts right to the heart of this whole relationship between housing, debt, and maybe the fundamental way we structure our modern lives.
Okay, what's the question?
It asks, quite simply, we need a crib to live or live to crib?
Hmm. Need a crib to live or live to crib?
Yeah. It's a question that really invites you to reflect, doesn't it? Are our efforts primarily focused on just securing that basic dwelling, the roof over our heads? Or has the pursuit itself, the management of property, the navigation of these complex financial systems we've discussed, the debt, has that become a central driving force, maybe even the main purpose of how we live?
A truly thought-provoking, maybe slightly uncomfortable idea to leave you all with after this deep dive.
Indeed.
Thank you for joining us.